What if time doesn't just move forward, but circles back on itself in cycles of fear and hope? Today on Eternal Philosophies, we unravel the meaning behind one of the most enduring mantras of Wall Street: sell in May and go away. But is it just a seasonal investing motto, or something deeper, a reflection of how we humans try to make sense of uncertainty? Warning: before we dive into the data, it's important to clarify, this is not financial advice. This video is a philosophical exploration of a historical market saying, not a strategy. Sell in May and go away may have some historical backing, but there is no proven cause and effect relationship and no justification for treating it as a reliable investment approach. It should be seen for what it truly is: a market motto, a joke, and not a market method. The phrase actually dates back to 18th century England. The full version was, sell in May and go away, come back on St. Leger's Day. St. Leger's Day refers to a famous horse race held in September. Back then, wealthy London investors would sell their shares in May, retreat to the countryside for summer, and return to the markets after the race. It was a lifestyle shaped by climate, class, and culture. The data behind the dogma. Sell in May and go away may sound like a catchy phrase, but is grounded in some historical data. For instance, according to the article The Halloween Indicator, Sell in May and Go Away, published by Sven Bauman and Ben Jacobson in the American Economic Review in 2002, the pattern is more than folklore. It's statistically significant. They analyzed stock returns in 37 global markets, going back centuries in some cases. Their conclusion? In 36 out of 37 countries, returns from November to April were consistently higher than those from May to October. In the United Kingdom, this pattern was visible as far back as 1694, suggesting that the phenomenon predates modern financial markets and may be deeply rooted in investor behavior. Additionally, let's look to this data published by Visual Capitalist in 2024, based on S&P 500 returns from 1950 through 2023. Here's what the average monthly performance reveals. November through April are consistently stronger months. November, plus 1.82%. December, plus 1.49%. January, plus 1.07%. March, plus 1.13%. April, plus 1.46%. Together, they account for the bulk of the market's historical annual gains. May through October, in contrast, are generally weaker. May, plus 0.3%, June, plus 0.11%, August, minus 0.01%, September, minus 0.72%. Only July stands out with plus 1.28%. The sell in May motto points to the fact that historically, markets tended to perform better during the colder months. Maybe when investor activity and focus were higher. However, it's important to note that this pattern doesn't always hold. In recent years, for example. According to Bloomberg and the Wall Street Journal, the summer of 2020 saw a strong rally, fueled by post-COVID recovery and central bank stimulus. Similarly, in 2023, the S&P 500 climbed more than 10% between May and October, defying the usual seasonal trend. Possible explanations. Why does this happen? There are several theories. 1. During the summer, trading volume drops. Investors go on vacation. 2. There are fewer earnings reports and economic updates. 3. Markets become more vulnerable to shocks due to low activity. And lastly, human behavior. We expect summer to be weak, and that expectation becomes a self-fulfilling prophecy. If everyone believes the rule and acts on it, doesn't that reinforce the cycle? The philosophy behind the mantra. Sell in May is more than a mantra. It's a window into how we seek order in chaos. Like ancient farmers planting by the moon, investors search for patterns, hoping to tame uncertainty. Today, trading is global, 24/7, driven by algorithms, bots, and news that breaks instantly. So we must ask ourselves, are we following wisdom or clinging to tradition? He who knows others is wise. He who knows himself is enlightened. Lao Tzu. In both investing and living, it's dangerous to move without knowing the reason behind our acts. We cannot just repeat rituals that we don't understand. The limitations. While some treat sell in May and go away like a strategy, it may be more accurate to see it as a mantra, a seasonal ritual passed down through decades of market lore. But even mantras come with consequences when followed blindly. For one, stepping out of the market each May means you risk missing out on unexpected summer rallies, as we saw in years like 2020 and 2023. Additionally, there is no guarantee that the past will repeat itself. And there are practical costs. Selling and re-entering the market can trigger capital gains taxes and incur transaction fees that quietly erode your returns over time. So whether you follow it or not, the real question is, do you understand why you're doing it? Because patterns only have power when they're examined, not obeyed out of habit. Sell in May and go away is more than just market wisdom. It's a mirror, reflecting how we cope with uncertainty, seek control, and look for cycles in a chaotic world. Thanks for watching. If this gave you something to reflect on, please like, share, and subscribe to Eternal Philosophies.